Hi, this is Kim, and this is week 5, and I'm going to give you a bit more information about bonds. So, first of all, I hope that all of you have listened to the Khan Academy video that was listed in the homework. It is important that you listen to that video first before coming here and listening to this video because it will give you some perspective and some information that will help make this more understandable. So I'm assuming you have, and with that, I'm going to start with talking about the investment pyramid. Talked about this before. The investment pyramid has 4 levels. The first level, financial security. This level represents our foundation, and within our foundation, we have cash equivalents from a couple weeks ago. Cash equivalents being the bank products, the government products, Series EE and I savings bonds and T-bills, and then finally money market account at a mutual fund company. We need those type of funds for the 4 reasons I talked about that may also come up on your exam, which would include liquidity, emergency fund, low risk, something to stand on, a way to launch our investment career. So that's level 1. This week we're moving up to level 2. Level 2, as you can read over here on the right-hand side, United States securities, but we're going to talk about that later. Particularly, we're going to focus on corporate and municipal bonds, corporate and government and federal government bonds as well. So that's what we're going to cover in level 2. And when you go over to the left-hand side, you will notice that this category in terms of risk is just above cash equivalents. So it is more risky than cash, but less risky than a lot of our stock investments. So I just want to note that we're moving up the risk category, and this week we're going to talk about bonds and why bonds are safe and what they are. So to move on from the Khan Academy video, I want to remind you that, pull this up over here, bonds have 3 features that I wanted to summarize. A face value or par value on any bond we discuss in this class is going to be $1,000. And this $1,000 represents the amount you will receive back from the company or from the government on the bond at maturity date. And it says right here, the date on which face value will be repaid, face value always being $1,000. Now I want to note right here that when bonds are first issued, they're issued at $1,000. But bonds trade just like stocks. So this $1,000 price will go up or down depending on market forces, what's happening with interest rates, other factors. So you will almost never have a bond purchased at face value, $1,000. Its value will change. When it is selling above $1,000, it's said to be selling at a premium. And when it's selling below $1,000, it's said to be selling at a discount. Last term here is coupon rate. Coupon rate is the stated interest rate on the bond. So if it's a 6% coupon, then the annual coupon payment will be, or interest rate payment will be this rate, coupon rate, multiplied by face value, which is again always $1,000. So if the coupon rate was 8%, then 8% multiplied times $1,000 would be $80. $80 is what you would receive annually, but you know that bond payments are made every 6 months. So for $80 you would receive 2 installments of $40. So I hope most of that is review because I want to talk about some other aspects of bonds, and I want to do that by, of course, going to a real website that lists the bonds that are currently out there. They may be owned by other individuals, they may not, but they're currently out there. So at this point, I'm going to pop into Google over here, and I'm going to go to bonds.yahoo.com. Bonds.yahoo.com. I'm going to make this full screen because we're going to be here for a bit. So right here at bonds.yahoo.com, we can see U.S. Treasury bond rates, U.S. Treasury referring to federal government. And we know that these 3-month and 6-month bonds represent T-bills. And we know T-bills is part of a cash equivalent at the lowest level of our pyramid. And then 2-year bonds, 3-year bonds, 5-year, etc. These are the bonds we're going to be talking about this week. Okay, and their current rates, interest rates, which again we can see is not incredibly that high except for a 30-year bond. But why would we lock ourselves into an interest rate of a 30-year bond when interest rates are so low right now and the only direction they can go is up? So if we did lock into this rate, we would have this rate for 30 years. And to me, that's not a good idea. But anyway, more importantly, when you're here at bonds.yahoo.com, I want you to pop over right here to where it says Bond Screener. And I want you to click on that. New page. Right here, select bond type. 4 flavors of bonds. We have Treasury bonds, federal government, Treasury zero coupon, which I'm excluding for right now, corporate bonds issued by corporations, and lastly, munis. Muni would be government bonds at the state, local, any other jurisdiction level. Okay, just not federal government, something other than the federal government. Right now, I want to look at some corporate bonds. So I'm going to go ahead here and I'm going to click on corporate. And then for right now, I'm going to look at a minimum maturity range of 10 years. So I'm only going to look at bonds that mature in a minimum of 10 years. I could have put other criteria on here, but for illustration, I'm just going to put 10 years for right now. And then I'm going to click Find Bonds. So now we talk about bonds that are listed, that were potentially owned by others, but anyway, that are out there. And we see that we recognize some of these companies. A lot of banks issuing bonds. GE Capital is a financial company, not General Electric like you would think of it. In fact, most of these are banks. That might be a question I ask. Why are most of these banks? But anyway, I want to move on to features of bonds. So this first feature here is price. Price. Wow. Look at this price of Citigroup. It says the price is $113.13. Well, that's a little misguided because what this is actually a percent of 1,000. To make the story short, you can read about it at more length in the book. When we determine the actual price of this bond, we have to multiply this times 1,000. This is a percent times 1,000. But in effect, all we're doing is moving the decimal over one place. So the price of this bond then becomes $1,131.30. That is the actual price. So if I ask you in a test or a quiz for the price of a bond that you look up, you're always going to move that decimal over one place, remembering that this is a percent of 1,000. Okay, bond selling for this amount is selling at a premium because it is above $1,000. Next column here is the coupon rate. Well, the coupon rate, 5.5%. So what would be our annual coupon payment? Well, remember, we take 5.5% and we multiply it times the par value or face value, which is always $1,000. So our annual coupon payment would be $55. Now, I want to caution you right now because often students make this mistake. They will multiply the coupon rate times the price to determine what the annual payment will be, and that is not correct. That is not what we do. We always multiply this coupon rate by 1,000. Maturity date, remember I said minimum of 10 years out, so that puts us to September 2025. So remember, on this date, you will receive par value back. So you will receive $1,000 back, assuming that you just purchased one bond. So moving on, well, what is this? What's the yield to maturity? Well, here's what the yield maturity is. In my mind, this is the actual return you will have on the bond per year. This is the annual return per year on the bond. Really? And you say, well, wait a minute, I thought I was earning 5.5%. But you're telling me that the yield is really only 3.989%. Well, that doesn't make sense. Well, let's think about this. If you purchase this particular bond today, you would pay a price of $1,131, a $131 premium. When this bond matures, you are only going to receive $1,000 back. So what happened to that $131 premium? Well, you ate that basically. That was the price that you paid for this particular bond so that you could have this 5.5% coupon and a maturity date of 2025. So your return is not going to be 5.5% because you had to overpay for this bond or pay a premium for it. So this is the representative return that you would receive on this bond. And the current yield, this calculation is just the coupon payment, $55, divided by the current price. So the actual yield today, this is what this bond is paying, $55 divided by the current price. The next thing is this rating. Okay, what is this rating? BBB, A's, so on and so on. Well, these Fitch, there's a couple other agencies, Moody's and Standard & Poor's, they rate bonds really to determine their ability to pay the coupon payment and to repay the par value at maturity. So they're looking at the financial health of the company and saying, how is this company doing? So if they are A companies, they're probably on solid financial footing and we don't worry as much about their ability to repay. Any kind of B, it could be B, BB, BBB, just Bs for now. They are not as financially solid as A companies, but heck, it's a B. And I think a B could still be pretty good. Now, a company that's not rated, well, that might be suspect, but maybe not. I mean, it's Barclays Bank. We would have to do some more research, but maybe that's okay. Sometimes, and I'll show you in a minute, we're going to find companies that have a C rating, any type of C rating. And just so you know, if a company is rated C, it implies that it's a junk bond. C would not be a high rating for a bond. It is an indication that financially the company may not be able to pay. So if you're going to buy a C-rated bond, please recognize that that comes with significant risk because you may not receive interest payments and you may not receive your face value back at maturity. You are exposing yourself to more risk. Okay, so the last line here is callable. Is the bond callable? And let me give you an analogy about that. Let's say that you needed to buy a car, but you had a couple dings on your credit report. So you had to go to a less than desirable car dealer to purchase a car, and they said, yeah, they'll sell you a car, but they're going to charge you interest on the car loan of 25%. Wow, 25%, that's outrageous for a car loan. But you don't have any choices, so you have to take it. Well, shortly after that, you receive this windfall inheritance from an unknown relative, and that inheritance is an equal amount to your car loan. Equal amount to your car loan. So the question in your mind should be, wow, should I go ahead and take this money and pay off my car loan at 25%? And hopefully you said, absolutely, I should pay this off because now I'm not going to have to pay 25%, which means I'm going to actually save 25% on an annual basis of not incurred interest costs. Well, that's the same thing with a company here. If it's callable, let's say the company has the money to erase the debt early, and they want to. They don't want to pay a coupon payment of, in this case, 5.375%. So what they can do is they can call the bonds in early and pay you off. Just go ahead and pay you your par value and whatever your interest accrued to date is, and you're done. So that means you won't have any future interest payments, and in fact, you won't be a holder of this bond anymore. It effectively adds a bit more risk to your bond purchase because you were counting on this. You were counting on owning this bond when in fact the company decided, no, we're not going to do that. We're going to call them in early. I will let you know that this is not random, that the potential call dates are listed on information when you purchase a bond. So that's my quick analysis of key terms in bonds. And now I want to go back to the bond screener. First of all, let's take a look at these coupon rates on Bs. We'll notice that the B-rated bonds have a typically higher rate than A's, except for this one right here, JP Morgan Chase. And maybe this was rated poorly when it first came out and it's now better. But anyway, B bonds, more risky because the company isn't as solid, should reward you with a higher coupon payment. That's how this works. So if you C bonds then, C ratings, hopefully we'll see, if my theory is correct, even higher coupon rates on those types of bonds. So let's head back to the bond screener. And I'm going to click on corporate bonds again. I'll still take a maturity range of 10 years. But now I'm going to look at these Fitch ratings. And I want to have, I only want to look at C-rated bonds. So I'm just going to put C's for mins and max. Oh, I think I did that wrong. Back up. Let's do triple C here. Should have done that in reverse. Okay, so now I have a list of only junk bonds. Ooh, Sears is in here, Albertsons, pennies. Not quite unexpected if you ask me. And look at these coupon payments. They are higher because you are exposing yourself to more risk. Therefore, you would expect a higher return, just like the investment pyramid. As you assume more risk, the reward should be higher. Now remember, the loss could also be higher too, because if one of these companies go out of business, you may never receive these payments. So that is the information I have here. I want to pop back in. I'm actually going to put a PowerPoint out this week so you can learn a bit more information about bonds. So again, here are the key terms. In this slide number 22, I really like images better than text, so I'm going to go mostly to images if I can. This is just a different type of treasury, different type of treasuries. Let me put this full screen. So T-bills, we already talked about, cash equivalents. Notes, note the time frame, 2, 3, 5, and 10. Okay, still interest is paid every 6 months. T-bonds, these are very long-term, 30 years, paid every 6 months into maturity. And lastly, we have something called TIPS, which I will tell you that they are another example of an inflation hedge, which means as inflation goes up, the return on these also increases. So we have sort of protection against inflation. The next slide I wanted to visit was slide number 38. This again talks about risk components. High grade, best quality, medium grade, here they are, speculative or higher risk, and junk bonds down here. Now, again, I just want to say that most of the A's and B's are going to be okay. Okay? And maybe even the C's too. You have a higher potential for return on C-rated bonds. But there's a list of what's going on with bonds. Now, current yield, I told you, annual interest payment divided by the current price. Again, yield to maturity, rate of return, who holds the bond to maturity. This is if you held the bond the entire 10 years to maturity. Okay? Something else I probably should talk about. Oh, here's an example of a bond quote for Home Depot. First one matures, yeah, we can see that in 2036. Current price, again, 93% of par value, which you just move the decimal over one place, you're going to get that answer. Pays an annual coupon of $58.75. Why is the yield to maturity higher here? Well, check this out. This price, $935, this means this bond is selling at a discount. So when the bond matures in 2036, what will you receive back? I'm sure you said $1,000. So you only paid $935 for it, but at maturity, you will still receive the full $1,000 back. So there you have it. Let's see. There is one more thing I want to point out, and that's formula for Muni bonds, if I can find it. So Muni bonds have some features that make them attractive to a certain population group. I think that's what I'm going to say. Hold on one second. Muni bonds are often tax exempt. Tax exempt. So the interest earnings you don't have to put on your tax return in the income portions of the 1040. They may also be state tax exempt if you live in the state where the bond is issued. So that's a huge savings. The interest you earn on these bonds is not taxable. But what matters is how they compare to a corporate bond. I'm actually, I didn't prepare to type this because I'm just thinking about it, but I'm going to give you an example and I'm going to use this formula. Let's say that we were going to compare an 8% corporate bond to an 8% muni bond. Okay? Well, you might say, I'm going to take the muni bond because the $80 interest is not taxable. Okay? In that case, it would make sense, 8 and 8. Okay, you take the muni bond, not taxable. Now let's say your choices are a 6% corporate bond and a 4% muni bond. 4% muni bond. Now the muni bond is not taxable. You're right. You're not going to be taxed on 4% or $40. But the corporate bond, you're going to earn $60. So that's $20 more in earnings. So I want you to think about that. Which one would you pick? Given this is the formula. This is how you convert the muni bond to its taxable equivalent yield, so that you can compare. You're going to take the tax exempt yield, that was our muni bond at 4%, and then go 1 minus your tax rate. 1 minus your tax rate. So if I took, in this example they used 5 5 divided by 1 minus this tax rate equals 0.0694, or tax equivalent yield of 6.94%. I'll go ahead and put an example of how to do this out in your out on the home page, because that always comes up as a sample problem on a quiz. I think I'm going to stop here. I'm at 25 minutes. I will put this entire PowerPoint presentation out here for you to review, and then tomorrow, Thursday, I'm going to assign some in-class problems, which I will put out there for you to practice, and then I'll create a tape over the weekend that shows how to solve these problems. So thank you, and I'll talk to you soon.